During the 2008 financial crisis, 25 banks collapsed, with nearly 400 more going out of business in the next 3 years. And even 15 years after that crash, things are not that different. Panic spreads again in the banking industry and financial markets, with 3 banks crashing within the span of a couple of months. These billion-dollar losses and multiple bank crashes unfortunately are not new news for us anymore. We have seen major banks failing basically since the Great Depression of 1929. But why is this the case? Why nearly after 100 years of continuous bank crashes, we are still seeing people lose their life savings in these collapses? And what are the current measures which might be able to help you in such a crisis? In order to find those answers, we need to look back and understand how we got here in the first place. The concept of a bank is about 4,000 years old, where people traded and stored goods rather than currencies. As there are obvious physical problems of trading goods at scale, slowly we moved to trading and dealing in coins and precious metal. And when that proved to be difficult to travel with over long distances and made major security issues, then about 1,000 years ago, China first introduced paper money. The paper money then and now are basically same in theory. You give your coins and precious metal to a trusting person or institution, and they will give you a note saying how much money you have given them. The ease of doing transactions with these notes helped businesses and economies grow rapidly. Even though everyone started to use this so-called paper money, the problem really started with the Great Depression, when we saw the first huge wave of 7,000 banks crashing in a couple of years. This drastic event led to the US removing its gold standard and also creating FDIC. Federal Deposit Insurance Corporation, which we also know as FDIC, was created to make sure deposits made by people in these banks are insured. And when a bank does crash and goes out of business, the people don't lose their deposits. FDIC is able to repay the people basically by either selling that failed bank and its assets to another bank, or by taking over everything and selling everything that the bank owns slowly. They also have another pile of money which they can use to pay us our money back. This pile of money is made up of premiums paid by the bank in case something bad happens, much like we pay our personal insurance premiums. So it might feel like, what's the problem here if we know our money is secured and insured? Well, firstly, that FDIC fund is only about 1.26% of the total deposits it insures, which means if more than 1.26% of all the money in the US banks is lost to bank failures, FDIC will run out of money to repay us our money back. And secondly, they don't really cover every dollar in your accounts. They cover up to $250,000 per insured bank. And in that, it depends on which account the money is in. Not every type of account is covered, so that detail alone can drastically change how much your personal losses are. So as we are questioning the capacity and ability of this federal corporation to repay our losses, you might be wondering about why the institutions who are meant to be the best with the money fail in the first place. Well, banks are just businesses, so yes, they are prone to the usual business risks like loss in revenue, mismanagement, and so on. But the unique thing about the banks is that they are also very much open to liquidity risk. What I meant by that is, when in the past we knew that the dollar in our hand is backed by gold, there was no risk to the intrinsic value of that bill. But now that we have gotten rid of that gold standard, banks are not really required to keep anything readily available which provides the dollar its value. For example, let's say you took $10,000 cash to deposit in your local bank today. Banks by law do not need to hold that money for you. Your $10,000 suddenly becomes banks' funds which they can use to give loans to other people. And that 0.01% bank will pay you as interest on your deposit. Banks could easily be making 7 to 10% on that money, if not a lot more. Up until a couple of years ago, banks were regulated to keep a certain percentage of your deposits in cash with them all the time. But during the crash of 2020, the feds changed that law and made the requirement to zero. So now the banks can use 100% of your funds to make profit on. This system is known as fractional banking, and it's the leading cause of these bank failures. Because if you were walking in a day after you made that deposit of $10,000 and take it out of the bank, then sure, you individually might not have any issue, as $10,000 is only such a small amount for the banks. But the problem happens when we see bank runs, which is a total panic situation in the market where more people go to the banks to withdraw their money than the amount of cash the bank has on hand. The panic of this situation only increases with time as more and more of the market loses its trust in the banks, which leads to more and more people withdrawing at the same time and more banks not being able to meet the cash requirements of those withdrawals. This is exactly what happened to Silicon Valley Bank in March of 2023. SVB wasn't able to meet the customer's requirement of withdrawals because they didn't have enough cash with them in the first place. They were forced to sell their investments at a loss to meet these demands. However, they only covered some people's account and made the overall situation worse by adding millions of dollars of investment losses to their balance sheet. But your loving FDIC stepped in and took care of things and basically guaranteed the depositors that they will get their money back. And obviously they didn't do anything about SVB's investors or creditors who lost their money in this crash. So the current solution we have is clearly not working because FDIC is only a cleanup company. They come in and try to clean up the mess the banks made. Not only that, as they are federal corporation, it's actually hurting us in two ways. So when FDIC goes to fix a bank crash and repay people, they will use the bank's assets or their FDIC fund to first repay as many as they can. As soon as they run out of money, they run to the federal government for help. The government obviously doesn't have any of their own money as all the money they have is our tax dollars. So one of two things happens. Firstly, the government can give FDIC our tax money to repay the public, and if the bank is big enough, they will also give the same tax dollars to cover the bank's losses and bail out everyone. Or secondly, when they have already spent all our tax money, they will beg to the federal bank for money. But the federal bank is not really a bank because no one can deposit money with them. So they order for more money to be printed. So regardless of what happens, either they will use your own money to repay us or just print more, which will increase inflation. Because by printing more and more money, the money loses its value because it stops being scarce. Why would the dollar hold its value when we know we can just print more? And recently, inflation has been a silent killer for all of us and our daily expenses. I know it's been problem after problem, but I think we can do something about this here. This whole downward pattern of regulations have been blamed to bad economical situations. From the Great Depression resulting to no gold standard to 2020 resulting to no reserve ratio. All of these laws were passed to kickstart the economy back because I don't think any political leader who was in office in those times wanted to be remembered as the person who didn't do anything. So everyone just kept on kicking the problem down the line by making flow of money easier and easier and forgot the whole point of something being valuable depends on its scarcity. So the reason I say that these banks will always fail is because currently there is no secret way to fix this solution. In theory, we can pass laws which will make the finance and the math side of this problem relatively manageable. But that will mean we will put more restrictions on the flow of money, from it getting printed to banks lending it out to the public. And no matter how hard the public pushes some extra regulations in the banking industry, in real world, no politician will give it a second thought, as it will not only mean them losing their funding on their campaigns from these massive institutions, but also passing laws which will restrict the growth of economy by restricting supply of capital. As the global change in banking system seems unachievable, a lot of people turn their focus towards things like gold and Bitcoin. Both gold and Bitcoin can be used as currency and they are only available in limited quantity. That limited supply gives them their intrinsic value. I'm not saying that we should put all our money in gold and Bitcoin, but it's more about the individual changes we can make to better the situation for ourselves. Here are some precautions or steps we can make in our own lives to better prepare for the next banking crash. So we know FDIC is a thing and it's not going away anytime soon. So we can follow their rules on what's insured and what's not. If we have to keep cash in accounts, at least we can have that insured and protect ourselves from one of the aspects of this banking failures, regardless of the demerits there. But the other aspect of increasing inflation due to these massive bailouts can be fought with investing in assets which on average beat inflation. Real estate and stock market are two good examples of such asset classes. And lastly, we can explore options into other investments like Bitcoin and gold who have some intrinsic value. None of these investments or strategies will protect you from losses during banking or financial crashes. But by spreading our investment into different types, it will on average reduce our losses until laws and regulations change in our favor. Let me know your thoughts on this whole banking situation. Thanks for watching and consider subscribing.